If you are in retirement or approaching retirement, you're probably familiar with the term IRMAA, IRMAA, otherwise known as the Income Related Monthly Adjustment Amount. Now, IRMAA applies specifically to your Medicare premiums and an extra surcharge that you would have to pay if your income is too high. And we've touched on this in almost every video about taxes in retirement and how this would work. But I think there's two things that people often overlook when it comes to their IRMAA thresholds. And while we'll make sure to get into those, we also want to make sure that you're fully aware of what IRMAA is and how you can avoid this stealth tax to make sure that you're not having to pay any more in Medicare premiums than you should be otherwise. If we've not yet met, my name is Danny Sinowitz. I'm a CFP professional from Hyperion Financial. If you haven't yet checked out the quiz in the description below, it's a good idea to do so to make sure that you're able to avoid IRMAA and other unnecessary taxes in retirement. So we've briefly covered what IRMAA actually is. And again, it applies to your Medicare Parts B and D premiums. As we've shown in this chart many a times, you can see the more income that you make, either as a single filer or a married filing jointly filer, the more that you have to pay in Medicare premiums. However, there are two things that I think people oftentimes confuse. The first one is the type of income that's considered when it comes to the income related monthly adjustment amount. And that is that this takes a look at modified adjusted gross income, not your taxable income. Where retirees can oftentimes get tripped up is understanding that taxable income and modified adjusted gross income do have some differences. The major difference is that the standard deduction is applied to your taxable income. However, it's not applied to your modified adjusted gross income. So when calculating for this, you want to make sure that you're not using your taxable income, but rather using the modified adjusted gross income number. When we take a look at what we just saw, the higher modified adjusted gross income you have, the more that you're likely to then be into one of these next brackets and have a higher premium surcharge. The other thing that can be a little bit confusing for retirees is understanding that this is a cliff schedule, not a marginal bracket. And what we mean by that is when it comes time to ordinary income tax or capital gains tax or even Social Security tax, if you go $1 over some of these thresholds, it's only that next dollar that's taxed at that next rate. So for example, if you cross from the 12 to the 22% threshold by $1, only $1 will be subject to 22% federal tax as opposed to your entire amount. However, when it comes to IRMAA surcharges, if you go $1 over, you're subject to pay that monthly amount for the next 12 months. That's why it's important to make sure that you avoid going over these amounts if at all possible. The other thing that retirees need to look out for is understanding that this is 2 years forward looking. So what we just saw was the 2025 brackets, but it's actually based on 2023 income. While it's impossible to fully know how much they're going to inflate the brackets by, you can get a rough estimate of what it will be if you're able to just compare it to how the previous growth has taken place in prior years. So while these are inflation adjusted to some degree, you want to make sure that you're avoiding going over if at all possible to make sure that you're not having to pay any more in Medicare premiums than you would be otherwise. I think it's also important to make sure that we talk about the income that actually triggers the IRMAA thresholds here as well. So obviously you're going to have your adjusted gross income that you'll have, but you'll also add back in capital gains and dividends. You could also add in the taxable portion of your Social Security benefits, which again, we've done plenty of videos on. So make sure you check those out if you haven't yet. But you also want to make sure that you keep in mind that if you have municipal bond interest, which could be tax exempt interest, that's actually added back in when it comes to your Medicare premium surcharges as well. So understanding that you have a feel for what your modified adjusted gross income will be so that you avoid these additional monthly premiums is a good idea to plan ahead for. The good news is that if you have an extenuating circumstance and want to appeal an IRMAA threshold that you have gone over, you can look to do so. The way in which you would do that is by filing a Form SSA-44 form. And this really involves a life-changing event. So you may want to also include additional documentation depending on what you're applying for. But some common things could be the death or disability of a spouse. It could be a work reduction or retirement. It could also include marriage or divorce, or it could also include maybe a change in your income, whether that be loss of an income producing property, loss of a pension, etc. If you're looking to file an appeal, you generally have about 60 days from your IRMAA notice in which you're able to actually have this submitted and reviewed. So making sure that if you do have a life-changing event, which could potentially save you from your monthly premiums and the surcharges that would come, it's worth making sure that you're timely with this. Now, the way in which you often will pay for these IRMAA thresholds is one of two ways. If you're currently on Social Security and collecting a Social Security benefit, these will actually be deducted directly from your Social Security benefits. If you're not yet collecting Social Security, but you are on Medicare, you'll actually be billed by Medicare for this income related monthly adjustment amount. So, making sure you have an understanding if you're planning to be on Social Security before you have this type of event will be important to make sure that you actually can pay this properly. So, one of the other questions is how can I actually avoid this or avoid going beyond certain thresholds? And I think that's something that you want to make sure of because, again, this is a cliff schedule, it's not a marginal schedule. So, if you go $1 over, it could put you in a position where you're paying an additional amount on both your Parts B and D premiums for 12 months. So, making sure that you stay under certain thresholds if you're close to them can be a smart strategic move. So, what are some of those strategies? Well, if you're a couple years away and you look like you're going to have a large RMD, it's not a bad idea to consider something like Roth conversions. Now, understand that if you complete Roth conversions, you're going to be paying tax in the year in which you complete them. So, the strategy may or may not make sense in your given situation. To understand if that's the case, you should check out the video that I'm linking to right now, which will give you a better idea of how Roth conversions work and who it should be right for. You should also make sure that you have a plan with your RMD. And if your RMD is going to drive you into a higher IRMAA bracket, you might want to look at some other considerations that you can be looking into to help offset some of the RMD income that you would have. You can also look at something like tax loss harvesting to lower your modified adjusted gross income. For many retirees, this is something that's often overlooked, but if you do have sizable capital gains, it can drive your modified adjusted gross income higher, thus driving these IRMAA thresholds higher and then causing you to have to pay more in premium 2 years later. If you're able to consider strategies like tax loss harvesting, that might be able to help lower your modified adjusted gross income and thus avoid Medicare premium surcharges. One of the biggest things I think you can do, though, is looking to actually create an income plan which will allow you to take strategically from your accounts. So, if you've done a proper job of diversifying your tax accounts, such as pre tax accounts, after tax, and Roth accounts, you might be able to create an income plan that will avoid going over certain income thresholds, but still allowing you to enjoy the type of savings that you've created and enjoy an income that's sustainable for you in retirement. And again, that's what me and my team at Hyperion Financial do. We help come up with strategies from both the investment side, the income side, and most importantly, the tax side to make sure that you're not paying the IRS any more that you have to, just your legal fair share. If you're looking to understand how taxes work in retirement, one of the big questions a lot of people are having is what's the future of Social Security tax? To understand how it's currently taxed, some legislation that's been put forward, and what some of the solutions could be, make sure you check out this video and you will find out more about what's upcoming and what could come down the road as we reach the end of the tax year.